There's a pattern in history that has ended global powers with terrifying precision. In 1580, Spain drowned Europe in silver, triggered runaway inflation, and went bankrupt 4 times in 40 years. In 1928, American stocks surged while gold quietly warned of stress beneath the surface, and within 12 months, $30 billion in wealth vanished. In 1931, Britain abandoned the gold standard after losing nearly half its reserves in just 6 years, ending its role as the world's financial anchor. Different centuries, different empires, same signal. The rally always comes first, then the collapse. And right now, in 2025, gold and silver are flashing the exact same warning signs again. While markets celebrate, debt explodes past $36 trillion, and policymakers insist everything is under control. And here's what should terrify you. This time, the scale is global, the leverage is unprecedented, and the margin for error is gone. Before we go through this pattern, you need to understand what gold and silver rallies actually mean, not in textbooks, in practice. These metals are not just commodities, they are stress signals. They move when confidence breaks, when systems strain, and when paper promises begin to wobble under their own weight. This isn't just about prices going up, it's about what forces them up in the first place. At first, everything looks healthy. Stock markets rise, credit expands, governments spend freely, debt feels manageable because asset prices keep climbing. But then something subtle happens. Gold begins to rise alongside risk assets, not instead of them. Silver, the more volatile metal, starts to outperform. That combination almost never happens in stable systems. It means liquidity is abundant, but trust is quietly eroding. This isn't about fear in the streets. It's about fear in balance sheets. When central banks inject money faster than real production grows, currencies weaken. When deficits become permanent, investors look for anchors. And when confidence in policy fades, gold doesn't wait for permission. It moves first. That's not theoretical. That's documented history. Every major financial rupture of the last 500 years showed the same early signal. Precious metals rising before the public understands why. Not because people suddenly loved gold, but because they no longer trusted everything else. When this process begins, it doesn't unfold slowly, it accelerates. Small imbalances compound. Political promises collide with mathematical limits. And once the signal is clear, the outcome is no longer a question of if, only when. Let me show you how it happened before, and why it's happening again. Let's start with the Spanish Empire. In the early 16th century, Spain was the most powerful state on earth. By 1550, it controlled territories across Europe, the Americas, and Asia. Its armies dominated the battlefield, its navy ruled the seas, and beneath it all was a single resource that seemed to guarantee eternal supremacy: silver. After the conquest of the Aztec and Inca empires, Spain gained access to the richest silver deposits ever discovered. The mines at Potosi in modern-day Bolivia and Zacatecas in Mexico transformed the global economy. By 1570, Potosi alone was producing more than 7 million pesos of silver per year. By 1600, Spanish America was supplying roughly 80% of the world's silver. In raw terms, over 150,000 tons flowed into Europe between 1500 and 1650. It looked like unlimited wealth. At first, the results were spectacular. King Charles V used silver to finance wars across Europe. His son, King Philip II, expanded the empire further, funding massive fleets, permanent armies, and a sprawling bureaucracy. Spain didn't need to build factories or develop industry. It could simply buy what it needed: grain from Poland, weapons from Italy, textiles from the Netherlands. Silver paid for everything. But here's what people didn't understand at the time. Flooding an economy with money does not create real wealth. It dilutes it. By the 1550s, prices across Spain began to rise sharply. Wheat prices tripled between 1500 and 1550. By 1600, they had increased more than sixfold. Wages did not keep up. Inflation eroded purchasing power year after year. This became known as the price revolution, and Spain was at its center. The cause was simple: too much money, too few goods. Spanish silver expanded the money supply far faster than agricultural or industrial output could grow. The effect was unavoidable. Each new shipment of silver made every existing coin worth slightly less. Gold and silver were rising in nominal terms, but real value inside the empire was falling. Instead of correcting course, Spain doubled down. By 1560, the crown relied on future silver shipments to fund current spending. It borrowed heavily from German and Italian bankers, especially the Fugger family, using anticipated silver as collateral. This worked until it didn't. In 1557, Spain declared its first sovereign bankruptcy. Then again in 1575, again in 1596. 4 times in total between 1557 and 1666. Each bankruptcy followed the same sequence. War spending surged. Silver shipments were delayed by storms, piracy, or declining mine output. Revenue collapsed. The crown defaulted. Credit evaporated. Then the cycle restarted. And here's where the pattern truly begins. As silver poured in, Spain stopped producing. By 1600, Castile manufactured almost nothing of value. Domestic industry collapsed under inflation and high taxes. Skilled workers emigrated. Imports replaced local goods. Spain became entirely dependent on foreign producers, paid with silver. By the early 17th century, the mines themselves began to fail. Potosi's output peaked around 1600 and then steadily declined. The richest veins were exhausted. Extraction costs rose. Mercury shortages slowed refining. Annual production fell by nearly 40% by 1630. The flow that supported the entire system was weakening. The consequences were immediate. With less silver arriving, Spain could no longer sustain its trade deficits. Imports became expensive. Inflation turned into scarcity. In 1627, Spain defaulted again. Soldiers went unpaid. Mutinies spread across the empire. In 1640, Portugal revolted and broke away. Catalonia followed. By 1648, after decades of war, Spain recognized Dutch independence, ending its dominance in northern Europe. The collapse wasn't sudden. It was structural. By 1650, Spain was still an empire on paper, but the system was hollow. Population declined, agricultural output stagnated, tax revenue shrank. The state that once dictated European politics could no longer finance itself without borrowing. This is what the precious metals were signaling all along. Silver wasn't making Spain richer. It was masking decline. The early rallies in silver and gold reflected excess liquidity and growing imbalance. The later shortages revealed the truth. You cannot consume more than you produce forever. You cannot finance empire with money creation alone. And you cannot escape the arithmetic of real resources. By the time Spain understood this, it was too late. The system had already completed its sequence. In 1700, when the last Habsburg king died without an heir, Spain was no longer the center of the world. It was a second-tier power, living off the remnants of past glory. That's what this pattern looks like. Massive inflows of money, asset inflation, loss of productive capacity, rising debt, political denial, and finally, collapse when the flow stops. And this was only the first time. Let's jump forward more than 200 years. The British Empire. At its peak in 1913, Britain controlled nearly a quarter of the world's land surface and governed over 400 million people. London was the financial capital of the world. The pound sterling was the global reserve currency. British banks financed international trade. British insurers underwrote global shipping. And at the center of it all sat gold. Before 1914, Britain operated the classical gold standard. 1 pound was legally defined as 7.32 grams of gold. Confidence in that promise allowed Britain to run vast trade networks with minimal friction. Capital flowed into London because the currency was trusted. Just like Spain, Britain appeared unassailable. Then came August 1914. World War I shattered the system overnight. Britain suspended the gold standard to finance the war. Government spending exploded. At first it worked. Just like Spain, Britain believed its position was unique. The empire would generate future income. The pound would recover. Gold would return. And in 1925, under Chancellor of the Exchequer Winston Churchill, Britain officially returned to the gold standard at the pre-war parity. This is where the same mistake reappears. By fixing the pound back to its old gold value, Britain effectively overvalued its currency by an estimated 10%. British exports became expensive. Coal, textiles, and steel industries lost competitiveness. Unemployment surged past 10% by 1926. Real wages stagnated, industrial output fell. Just like Spain, Britain responded by defending appearances instead of fundamentals. Interest rates were kept high to protect gold reserves. This strangled domestic growth. Capital flowed out. Gold followed. Between 1925 and 1931, Britain lost nearly 40% of its gold reserves. Sound familiar? The cause was structural. Britain was no longer the world's dominant producer. The United States and Germany had surpassed it in industrial output. But Britain still consumed, governed, and spent as if it were. Imports exceeded exports year after year. The empire ran persistent current account deficits. Gold covered the gap until it couldn't. By 1931, the situation turned critical. A banking crisis in Austria spread across Europe. Investors demanded gold. In just 6 weeks, Britain lost 200 million in reserves. That's roughly half its remaining gold. On September 21st, 1931, Britain abandoned the gold standard. The effect was immediate and irreversible. The pound fell 25% within months. London's role as the world's financial anchor ended. Countries across the empire followed Britain off gold. The international monetary system fractured. Just like Spain's defaults rippled through Europe, Britain's decision destabilized global finance. Notice the pattern. Massive debt accumulation during expansion. Dependence on financial prestige rather than production. An overvalued currency defended by policy. Gold quietly draining away. Then a sudden break when confidence snaps. The consequences played out over the next decade. Britain never regained its pre-war position. During World War II, it relied heavily on American loans and the Lend-Lease program. By 1945, Britain owed the United States $4.3 billion, a staggering sum at the time. In 1947, it was forced to devalue the pound again. In 1949, another devaluation followed. Different century, different continent, identical collapse. Just like Spain, Britain believed history's rules didn't apply. Just like Spain, it trusted paper promises over real output. And just like Spain, the precious metal signal came first. Gold wasn't rising because of speculation. It was responding to stress, imbalance, and denial. History was repeating itself, and it wasn't finished yet. Now, let's look at the most recent example. And this one is uncomfortable because you probably remember it. The United States in the 1920s. After World War I, America emerged as the world's dominant creditor nation. By 1921, the United States held nearly 40% of the world's monetary gold. European economies were shattered. Britain was weakened. Germany was burdened by reparations. Capital flowed into New York. The dollar became the center of global finance, even though the pound still held the formal title. The decade that followed looked like a golden age. Industrial production surged by more than 50% between 1921 and 1929. Stock prices exploded. The Dow Jones Industrial Average rose from 63 points in August 1921 to 381 points by September 1929. That essay six-fold increase in 8 years. Credit expanded rapidly. By 1929, margin debt allowed investors to buy stocks with as little as 10% down. At first, everything seemed justified. New technologies, electrification, automobiles, radio. Productivity gains were real. But here's the critical detail. Asset prices rose far faster than wages. Corporate profits surged, but household debt surged faster. By 1929, consumer installment debt had doubled compared to 1920 levels. The system was running on leverage. Now watch the metals. Gold, under the gold standard, was fixed in price, but its movement showed up in flows. Between 1927 and 1929, gold began moving aggressively into the United States from Europe. Central banks sensed instability. They converted paper claims into metal. Silver prices, less constrained, began to rise relative to industrial demand. The signal was subtle, but it was there. This is where speed matters. Spain's decline took decades. Britain's took a generation. America's rupture took months. In early 1929, the Federal Reserve raised interest rates to slow speculation. The effect was immediate. Credit tightened. Brokers called loans. In October 1929, the market cracked. On October 24th, Black Thursday, 12.9 million shares traded. On October 29th, Black Tuesday, another 16.4 million shares changed hands. The Dow collapsed nearly 25% in 2 days. But the crash was not the collapse. It was the trigger. Bank failures followed. In 1930 alone, over 300 banks failed. By 1933, more than 9,000 banks had closed. Depositors lost savings. Credit vanished. Industrial production fell 47% between 1929 and 1933. Unemployment reached 24.9%. Nearly 1 in 4 workers had no job. Here's what should really concern you. The entire system unraveled faster than anyone expected. From peak optimism in September 1929 to total banking paralysis in March 1933 took just 42 months. Confidence didn't fade slowly, it snapped. Gold again told the story. As banks failed, Americans hoarded gold. Reserves drained. In 1933, President Franklin D. Roosevelt suspended gold convertibility and ordered citizens to surrender gold at $20.67 per ounce. Within a year, gold was revalued to $35. That was a 69% devaluation of the dollar overnight in real terms. Compare the timelines. Spain's system took nearly 100 years to hollow out. Britain, yes, took roughly 35 years from 1914 to 1949. The United States went from boom to monetary reset in just over 3 years. The pattern was accelerating. 3 times, 3 systems, 3 collapses, all following the same sequence. Excess credit, asset inflation, precious metals signaling stress, political denial, and then a break so fast that explanations came only after the damage was done. And that brings us to now.